All right. Like I said, you've got Austin Fitch here from Horizon Investments, and appreciate everybody taking the time, taking some time out of your lunch. We've got Scott Ladner here, our head of investments, who's joining me, and we're going to walk through our market overview for Q4 and our outlook for at least the first quarter, if not a little bit further into 2019. What you'll find, and for folks that have been with us for a while, what we've done this quarter is really try and highlight the relationships that we've formed with a number of different advisors and capitalize on that by creating kind of a community here where folks can hear questions from other advisors, kind of spark some conversation, spark some thought. So this call is meant to be interactive. You'll note that there is a way that you can ask questions as part of the GoToWebinar software, so please don't hesitate to do that. As we get rolling, we'll be able to address those on the fly if there are questions throughout the deck. And then at the end, we will open it up for Q&A. Should there be any follow-up questions or additional items that anybody wants to touch on. We've got about 15 or 20 slides here that we're going to go through. And then, like I said, we've got time for Q&A, typically looking at probably about 25 to 30 minutes worth of content that we'll go through. But here you can get a sense of what we're going to talk about today. I talked about kind of a review of the quarter. Obviously, we all saw the volatility during the fourth quarter. We're going to talk about that, kind of some of the reasons that we saw some of that volatility, but then also what we're seeing going forward and the effects of that volatility. We're going to talk specifically about the Federal Reserve and the communication policy that they are currently following, and obviously the effects that had on markets in the fourth quarter. Then we're going to dive into the fundamentals, both at the corporate level and then also at the economic level, and give you some detail there. The fact that we are seeing some strength is supportive of hopefully a strong 2019. And then finally, we'll touch on what seems like a topic that has lingered for probably at least a year now when it comes to the trade conversation, tariffs, and obviously the geopolitics that are involved in all of that. So with that being said, we'll really dive right in to what we saw in the fourth quarter. And for those of you that have been with us in previous quarters, this is kind of a spin on what we normally do from a quarterly performance and asset class review. What you'll see is we broke out 2018 into two different time periods. The left-hand chart being what we saw during the fourth quarter. Obviously, we are all familiar with the drawdowns that we saw in markets there, specifically domestic markets drew down, with small caps being the most severe. But then on the right-hand side, what you'll see is returns that we saw during the first 9 months of the year. And the interesting thing to point out as you compare the two time periods is emerging markets and really internationals in general, but emerging markets specifically, during the first 9 months of the year, were down over 5%. During the fourth quarter, emerging markets were actually the best performing equity asset class that we see there on the left-hand side. Not something that you would normally expect when you think about a market sell-off. Generally, you would think your traditionally high beta market segments would sell off more. I think what you started to see, and we'll talk about this as we get into the presentation here today, but much of the bad news surrounding emerging markets, and specifically China, was factored into markets and valuations during the first really 9 months of the year. We saw some significant moves early in the year that affected the returns in the first three quarters. That being said, we also take a deeper dive into different areas of the market, and specifically what we're looking at here is Morningstar category data for the last 40 years. And we were really looking to see if there was there a specific set of asset classes or maybe a subset where there was an opportunity to avoid some of the sell-off that we saw and the down markets that we saw specifically in the fourth quarter, but more broadly across 2018. I think what you can see here would suggest that there really wasn't a place to hide. Nearly 80% of Morningstar categories actually had negative total returns during 2018. The dotted or dashed line there towards the bottom of the chart indicates what the long-term historical average is in terms of number of or percentage of asset classes with negative returns. That's 23%. So obviously that helps put 2018 in context, where you had over 3 times the normal number of asset classes that had negative returns during the year. Another point to talk about, and I know we've talked about this from a volatility perspective and from some of the strength when looking at the last couple years in the market, you can actually see that pretty clearly if you look at 2016 and 2017 in terms of asset classes with negative returns. You saw pretty strong equity market returns in 2017, which only added to the disparity, I should say, with what we saw in 18. Moving on to kind of talk about some of the volatility specifically. So this is a chart of the VIX, which is volatility on the S&P 500. Typically a measure of volatility that's used across, whether it be CNBC or Bloomberg or the Wall Street Journal, and gives you an idea for really market volatility. I know we've looked at volatility specifically in 2017 being abnormal. So this chart gives us a couple of different data points that's worth looking at. The first, the orange line there, is the long-term average for the VIX. You'll note that that's just under 20. The VIX goes back to 1990. So to put that in perspective, that was well above where we were in 2017. The average you can see, so this chart looks at 2017 and 2018, the 2 calendar years. The average for 2017 is that light blue line there on the left-hand side, just above 10. So again, putting 2017 into a frame there gives you an idea that 2017 really was abnormal. It's interesting to note that as we get into 2018, the average for the full year of 2018 is actually that pink line that we're looking at. And you'll note that even with the spikes in volatility that we saw in February and the increased volatility that we saw in the fourth quarter, the average for the overall year was actually still below the long-term historical average. Maybe surprising to folks when they look at that relative to what is kind of viewed as historically normal. I think what a lot of us remember and obviously have some recency bias would be the fourth quarter. We can obviously see the spike in volatility, especially in the month of December, right there around Christmas. But what you'll note is the average for the fourth quarter was a little bit higher than long-term normal from a volatility perspective, but it wasn't significantly higher. Not to say that the volatility didn't feel maybe worse than it otherwise normally would have, given where we were coming from. But that helps to hopefully paint a picture of kind of historical norms, but then also where we've been over the last couple years. At this point, I will maybe hand it over to Mr. Ladner here and let him talk about maybe some of the, one of the drivers that led to some of that volatility, especially in the fourth quarter.
Yeah, thanks, Austin. So one thing that we always need to ask ourselves when we're trying to figure out what's moving markets and why things are behaving violently is, are people actually playing this game? One way to measure that is by looking at liquidity on something like the S&P 500 E-mini futures contract, which is the most liquid equity contract in the world. And what this chart depicts is the fact that really nobody was playing this game. There was really very small, very thin, like historically horrific liquidity in the S&P 500 E-mini futures contracts. There just were no contracts on the bid and the offer. So what that means is if for a given dollar amount that you need to sell or buy, that given dollar amount is likely to move markets more over that fourth quarter than it would have really pretty much at any other time in history. Anecdotally, we can say the same type of thing about bonds. talking to the variance guys, talking to other people that run institutional high yield portfolios and other things. Essentially, bond guys took essentially November and December off. They kind of shut down. There were just no bids, and we're seeing, and they were saying, they were saying, Scott, listen, when the calendar turns, we can take risk again, but right now, just risk managers are running our books. We're just not allowed to really make markets. We're not allowed to be buyers of bonds. And this is what you're seeing here too. This is a picture of what happens when risk managers take over portfolios. It's not portfolio managers trading; these are risk managers trading now, and they're saying we do not want to take risk. That happened in the bond space. It's happened in the equity space. It's one of the reasons why we think once the calendar turned and the investment managers start taking back over trading portfolios, we've actually had better liquidity profiles. We've had a little bit more constructive price action, obviously, but it should not be misunderstood or underappreciated. The magnitude of the effect that poor liquidity had on markets, especially in December, was really pretty strong, and I just don't know that everybody really understands quite how that ended up working.
So, Scott, I think that contributed obviously to some of the wild swings, which then probably contributed to some of the investor sentiment and even kind of retail thoughts around potentially a recession. I know we use Google Trends here at Horizon. Maybe give folks an idea of what we're looking at and kind of how we use it.
Yeah, I mean, this is just if you want to get a sense of what the world is looking at. So, everybody uses Google. I don't think anybody doesn't use Google. But Google has a neat little feature where you can go and you can search the history of a particular search term through time. And so if you go back and you just look at recession, and Google recession, or frankly, if you Google bear market or anything having to do with like stock sell off or anything like that, the graphs all kind of look like this. And people are really got scared. And this is just general public. People really starting to get pretty worried that the recession's imminent. It's a view that we take quite a lot of umbrage with. We don't agree with that. We don't think the data support it. We'll go into some of those things here in a bit. But the psyche of the individual investor, likely most of your clients, is that a recession is a real probability and it's fairly imminent.
So I think it would be fair to say that probably led to some of the fund flow data that we look at. Maybe give us some detail around what we're looking at here in regards to fund flows and kind of how that affected the liquidity piece of the market as well.
Well, I mean, so behavior. We all know that behavior helps drive, helps drive markets. And one of the reasons why we do look at things like Google Trends occasionally is to try to get a sense of behavior, get a sense of where people's psyches are. But if you think a recession is coming, you just blow out of stuff. And so this is looking at redemptions and mutual funds over the last 12, 13 years. December saw that the most fund outflows that we've seen in over a decade. Far worse than 08, far worse than even 15. Now, granted, there's likely quite a lot of tax selling going associated with this, but nevertheless, selling is selling. And when you're selling into a very thin liquidity market, bad things can happen. At least we certainly saw that in December. But these fund flows were certainly indicative of a fairly poor retail psyche. As we're going to see in a minute, there's also a poor professional psyche. But those things combined with a poor liquidity environment can get you some pretty wicked moves like we saw.
So Scott, you touched on it, but maybe I'll kind of back it out for a second. Normally, when we're looking at the retail investor, it's oftentimes the retail investor is doing one thing and the professional money manager maybe is doing something maybe even 180 degrees different. I would say during the fourth quarter specifically, it did not play out that way. It actually, they both did very similar things.
Yeah, and this is shocking to me. This is professional asset managers, professional investment managers have have the worst view of the economy since the financial crisis. Well, that's crazy. We'll see why that's crazy here in a minute. But off the back of tax reform, off the back of all this deregulation, and off the back of a 4% GDP print, we're expecting things to go in the toilet. That's just not. It's inconsistent with reality, but it certainly is consistent with psyche. It's very consistent with sort of the news flow, and it's very consistent with the behavior of retail accounts. But that kind of behavior, that kind of outlook, makes an outcome like this fairly predictable and kind of understandable. These are changes in professional money managers' portfolios in December. You can see just people just blowing out, just getting out of equities. get me out. Get me out of energy. Get me out of oil. Get me out of the U.S. Just buy me the safe stuff. By the way, safe stuff includes EM now. Give me bonds. Get me out of equities. This is very consistent with the flows we saw. Very consistent with the retail psyche. Very consistent with the professional money managers kind of outlook on the economy. It is this is all of this stuff matters, but it matters so much more in the context again of really crappy liquidity conditions. There were just no buyers in December. I mean, it felt like there were no buyers, but we can actually go out and see there's really just everybody that could sell was selling in December. These are pretty interesting opportunities.
So obviously we've talked about volatility, and I think a lot of maybe the volatility even stems back to late September, early October, when there were conversations and comments made by Chairman Powell from the Fed. And I think we've talked internally around the Fed's, maybe we call it communication strategy, maybe it'd be more aptly named a miscommunication strategy. I think what we're showing here, and I know it may be tough for folks to read on the screen, but this is just a snapshot of maybe the two different, the fact that the Fed in a sense is speaking out of both sides of its mouth. So on the left-hand side is the press release that was published along with the meeting there on December the 19th. And we've highlighted a statement on that press release that says that the committee judges risks are roughly balanced, but will continue to monitor global economic and financial developments and assess their implications. Generally, from just the face of that text, seems like a pretty positive term for or a pretty positive statement for markets. No later than 2:15, when the press conference really kind of kicked into full swing, we've included an excerpt on the right-hand side from a question that Chairman Powell received about what the markets are telling the Fed. And at that point, that's when Powell made the comment that some volatility doesn't probably leave a mark on the economy. So if you try and rectify the fact that they're monitoring and will assess implications, but that they don't think volatility is leaving a mark on the economy, two very different kind of viewpoints. And Scott, maybe let's touch on kind of why that's confused the market and obviously the effects of that.
Yeah, and so just to take a half step back, when Jay Powell was confirmed when he was coming into office, people generally thought that they were getting a pragmatist. And we were not getting some egghead academician who's never lived in the real world, relies upon models exclusively, and does all of the stuff that there's great things about academia, but sometimes the ignoring of the practical side of things. We thought we were really getting kind of a practical guy in Powell. And his behavior since then, up until this past Friday, has been anything but pragmatic and practical. He's been very theoretical. He's been very abstract. He's been very apparently relying upon models, but he's also been flip-floppy. So in his August Jackson Hole speech, he talked about not relying upon the stars, which is basically a hit at sort of the Fed econometric models. And then he goes back and talks about relying on those models and talking about things in the abstract. It's just been kind of all over the place from a communication standpoint. So the market really doesn't quite know what to expect or what to get from them, or they haven't at least. You compound that then with what he said on October 3rd in an interview. It seemed like almost an offhanded comment that really started all the selling in this quarter. And the comment was about the fact that he believed that we were a long way from neutral in terms of the Fed fund rate. All that means is that the Fed's going to keep hiking for a while. And the market was not expecting the Fed to keep hiking for a while. That miscommunication gap really started some of the selling because we just didn't know what to expect. And in a world where central banks matter a lot, little missteps can have a pretty outsized influence, and that's really what we got out of them. It was a communication error, the central bank error on October 3rd that really started all the selling, and then the liquidity vacuum really exacerbated it. But in order to get out of something like that, you need a central bank fix. What we got on Friday, not only the payroll numbers, but Powell's statements when he was with Yellen and Bernanke, really a pretty dovish pivot that he made. That may have been his way of trying to fix this and understand, get in line with the markets, or at least be recognizing that markets exist and that they matter to some degree. That kind of statement was the fix that we might have needed in order to get out of this hole we've been in. Maybe a little bit too early to tell, but a selling that started with a communication gap or communication error from the Federal Reserve needed communication fix. That's what we think we got on Friday.
And Scott, I know we've talked internally. I think it's really interesting if you look back at, I would say, the most recent kind of market sell-off over maybe a prolonged period of time. So fall of 2015, beginning of 2016, you actually saw a very similar reasoning behind that, be it maybe a different country's central bank.
Yeah, I mean, so this most recent period is definitely the most similar to the August 15 to February 16 period. It was also pretty nasty in terms of asset performance and in terms of volatility. But that period also got kicked off by a central bank mistake. By the way, we also had the backdrop of global growth fears. So back in 15, there's fears about global growth. There's fears about earnings recessions, all these types of things. That sound familiar? That's what we got right now. Now, we don't think it makes a whole heck of a lot of sense right now, as we'll show here in a minute. But there is definitely that talk. There's definitely that fear right now. So against the backdrop of global growth fears, you get a central bank mistake. That's what happened in 15 when the Chinese central bank raised, devalued their currency. They actually did it twice, both in August and December. The only way that episode got fixed was when they all deny it, but there's the Shanghai Accord. It was essentially a currency detente that happened in early February at the G20 meeting. That's what solved that episode, and so you need a central bank fix to solve a central bank created problem. Hopefully, what we got on Friday was the central bank fix that was originally caused by Powell's central bank error.
So, given kind of that conversation, and obviously, starting to look at potentially where rates go from here, given some of the communication that has taken place, it's really interesting, I would say, to see as we start to look at rate expectations going forward. So what you're looking at here, and again, for folks that have been with us in the past, we've looked at a similar chart a number of times, and what you're looking at is rate expectations, but really a divergence of rate expectations between kind of what the Fed's dots would tell us. So the Fed puts out what's called their dot plot and gives expectations for where rates will be heading on the Fed funds rate heading out 2-3 years. That's the blue dotted line on this chart going forward into 19 all the way into 21. You can see that the Fed's dots, which suggest 2 rate hikes, 2 25 basis point rate hikes in 2019, another rate hike in 2020, and then basically be done for some time. What you'll note that the market's expecting as of late December was maybe 1 rate hike. You can see that it's slightly above kind of where we were, where we are currently, but then actually really no additional rate hikes after that. I think that's very interesting to see, and actually one data point that we've looked at and that we look at internally would actually suggest rate cuts as early as 2020. So Scott, maybe give us your thoughts on that.
Yeah, I mean, I think that this might be a little bit too sanguine of you for how the market's pricing in the probable path for Fed funds through the year. What this is and it sounds complicated. It's not all that complicated. This is a 2-year forward 1 month Fed funds rate minus a 1-year forward 1 month Fed funds rate. All that means is what's the market expect the Fed to do in the year 2020? And when you see that sign going negative there, what that's saying is that sometime during the year 2020, the market is pricing in the Fed maybe is going to cut once. I'm not sure we quite buy that. That might be going a little bit overboard because for the Fed to be cutting, you probably need a recession, or at least the hints that one may be coming. So that might be a little bit overdone, but things that overshoot one way or the other, it's not an unusual thing to happen. But the market is definitely expecting the Fed not to continue his hiking pattern, which we think is important.
One other chart that we just wanted to kind of show again for folks that maybe haven't seen it. So this is a chart that we look at pretty closely to get an idea for the relationship between yield moves and stock returns. And I would say the important kind of fulcrum point there with the orange dotted line is really that 5% number on the 10-year Treasury. And what you see from a correlation standpoint would suggest that interest rate moves prior to the 10-year yield being above 5% generally have a positive correlation, with stock returns. Obviously, as we get past 5% on the 10-year Treasury, you start to see that maybe limit growth a little bit, maybe cause other issues in the economy. But this is one that we continue to look at. Should there be future rate hikes even in 2019 that would maybe be supportive of continued strength in equity markets? Again, knowing that the paths between kind of what the Fed expects and even the market expects have diverged, there is kind of a silver lining even if we continue to get rate hikes heading into 2019. That being said, we'll kind of turn the focus to the fundamentals a little bit, and looking at what we're looking at here is a chart of earnings, an earnings overview, if you will, of earnings season that finished up during the fourth quarter. And again, what you'll note is when looking at whether it be top line growth, so that's sales growth, or bottom line growth, so looking at earnings, you've seen year-over-year growth really across the board in every sector, in many cases double digits, suggesting strength really across the economy. However, if you kind of take it to the next level, the question and much of the reason maybe for the concern from a broader economy standpoint is the fact that earnings growth may have peaked. So what we're looking at here is historical earnings growth prior to the fourth quarter of 18, but then also expectations heading out to the end of 2019. And what you'll note is while, yes, we may have hit a peak in terms of a growth, year-over-year growth on earnings, be it that Q1 and Q2 of 2018 were both well above 20% year-over-year earnings growth, which I think we would all agree is definitely a little stronger than usual, may even be considered abnormal. The fact that you're looking at growth continuing on a quarterly basis to be positive out until the end of 2019, in some cases well above double digits, I think speaks to what Scott has referenced as being a tough environment to really expect to see a recession. Generally speaking, and we've looked at charts in the past with many of you, if you're looking for kind of the precursor to a recession, generally you will start to see earnings growth turn negative. The fact that expectations for earnings growth to remain positive, and again, in some cases, significantly positive, is a good indicator, I would say, for the economy going forward. And I guess the good news is it's not the only data point. Scott, we've got a number of charts here that would suggest that economic activity is actually really strong.
Yeah, I mean, so frankly, I don't spend a whole lot of time looking at the big, slow-moving macro variables, but they can be instructive just to at least kind of confirm or refute a thesis that you think you've got one way or the other. And so, what I call your attention to is some of these periods around 2015. Obviously, in 08 and 09, that's a different story, or actual recession is different stories. But if the period that we're kind of going through is sort of kind of rhymes with late 2015, early 2016, let's kind of look towards those and see if these kind of fears are warranted or not. So if we go with the upper left quadrant is Goldman's current activity index for the U.S. That doesn't look like a recession's coming. I mean, if you look at the 2015 period, you can see things slowing down pretty materially, getting towards zero. We're not there. Going below that, just railroad freight car loads, just like how much manufacturing, how much stuff's being moved on the roads, how much stuff's being moved on rail, like just kind of old school manufacturing, just activity kind of stuff. You can see it actually did negative year over year in 2015, 2016. That was kind of a fear, and a fairly legitimate one. Like, does it look like it now? Like, no, of course not. So one thing that always has to lead a recession is consumers have to get scared. The top right graph is retail sales. They just printed a record in December. Now, obviously there's seasonal things in there, but does just the trend of that over the last couple of years, does that look like the consumer is scared or in kind of bad shape? Are they delevering? Are they hunkering down? They're doing all the things you get kind of as you come into a recession? Like, no, not. They're really, really strong. And then one that kind of takes a lot of these things together is just the Conference Board's leading economic indicators index. That's the bottom right panel. And again, if you look at the 2015, 2016 period, it was declining, getting pretty close to zero. and people were, kind of legitimately started to get a little bit concerned. We did have an earnings recession in the U.S. here in 2015. Not nowhere close to that, as I also just showed you. And this, the LEIs are just not, they're not at levels that we've ever had anywhere close to when a recession is starting. Like none of these charts, none of the data, like I could point at 40 other things. There's just nothing that's confirmatory about there's a recession imminent in the next 6 months, really even in the next 12. Now, I'm not saying that you can't have some sort of external catalyst of 9/11 or something silly like that would push things one way or the other. But just as things sit here today, there is just no evidence that is supporting any thesis that the U.S. is headed for a recession soon. And if the U.S. is not headed for a recession soon, then multiples have some room to grow and earnings have some room to grow. It's that's kind of the baseline of a lot of our stories.
Yeah, so I would say another thing that we're looking at, and many of the calls that we've fielded and questions that we've answered, oftentimes have to do around the tariff conversation. And this is maybe just another data point to speak to that, but the conversation has really been around the impact of tariffs on global production and global growth. And what you're looking at here is the Purchasing Managers Index for a number of different countries and regions. And what I would draw your attention to on the far right-hand side is even in the face of maybe a more nationalistic economy in the U.S., but also in a number of different international countries, you really haven't seen significant pullback in kind of the PMI data. You haven't seen significant changes from 2017 to 2018 that would suggest that the tariffs are having severe impact on trade. I know we've talked about it with a number of folks that if you actually run the tariffs through the GDP equation, the impact is minimal at best, to the tune of maybe a tenth or a couple tenths worth of GDP. You're not, if you read the news or if you're reading the headlines, you're probably of the opinion that tariffs are going to take growth from 3% to 0. I think the data, again, if you actually run the numbers, it would tell you that it may take growth from 3% to 2.9. So I think that's something that probably has been overblown a little bit just from a news cycle standpoint. Again, not to say that we're not going to continue to monitor this, but I would say that the tariff impact has really been minimal in terms of growth expectations. Maybe moving into another conversation around the kind of the geopolitics, specifically on the international side. We've talked with a number of folks about a risk that we're at least watching for in 2019 is Brexit. So I know many of you remember pretty vividly the actual vote for Brexit a couple years ago, and you actually saw markets sell off about 10% over the course of 2 or 3 days following the vote for the UK to leave the EU. I think what we've talked about is that was really just a vote. Nothing actually happened in terms of there were no, trade could still flow between borders. There wasn't necessarily any impact. We are now coming up on at the timeline that is set currently, which we've seen these move repeatedly, is the end of March of this year for the Brexit kind of process to be finished. Now, I think it would be fair to say that we could very easily see that pushed. But what you're looking at here just shows you how convoluted and complicated kind of the whole Brexit process really is. To say that it's chaotic would probably be an understatement. You'll note that a parliamentary vote, which is on this graphic that was scheduled originally for December 11th, has actually been pushed to next week already. So again, the March 29th deadline could very easily be pushed, but I think one thing to at least watch for in terms of market risks, and Scott mentioned kind of a event risk that bears monitoring. The Brexit process could give us anything from the UK remaining in the EU to restarting the Brexit negotiations altogether. So I would say that's something that we're monitoring for. Scott, anything you want to add around Brexit and maybe Horizon's kind of view on Europe or international specifically in relation to that?
In relation to Brexit, so what this chart tells me, and it came from RBC, they're a Royal Bank of Canada, and it looks to me like the Royal Bank of Canada doesn't have the foggiest idea what's going to happen. Neither do we. I don't know that any flow chart with this many boxes is sensible. And so ideally, if you're going to play things out scenario-wise, the way you do that is you say, listen, here are the possible outcomes. I'm going to assign some probabilities. Possible outcomes. I'm going to monitor signposts for progress towards these possibilities, and I can adjust my probabilities and adjust my outcomes. Blah blah blah. And that's how you play scenario games, right? I don't know how to play a scenario game with this, so we're just choosing not to play this game right now. We're going to monitor, and when things become slightly more concrete than this disaster of a scatter plot, then we'll have a shot to make some sense of it. Till then, it's just like you can't trade on it. And you certainly can't position against it. So we're neutral on them right now, pending more information, because I just don't know what else to do about it. Either way, we don't think UK is not we're not in 1918. We're in 2019. They're not as big of a piece of the economy as they used to be. The global economy. This is really an economy about Germany, the U.S., and China. And so this is, even if they did the most silly thing ever and did the thing that hurt their self the most, the impact on global economy would be pretty minimal, frankly.
The only other piece that we'll touch on here in regards to geopolitics, so this is just a kind of an overview of kind of many of the buzzwords that I would say most of us have heard in regards to geopolitics, but it hits on a few specific points. Obviously, the Chinese trade deal is one that we're watching pretty closely. Many of you get Greg Vallier's daily piece. We're watching those negotiations between the U.S. and China, so that's something that obviously will have an impact heading into the first quarter. I would say the government shutdown is another one that's getting many headlines here recently. I think we could probably make the argument that there's not been a significant impact to markets, at least at this point, but that's something that for sure we will continue to watch and continue to keep an eye on in regards to the effects on the markets. I would say just generally, geopolitics will continue to matter in 2019, as the nationalistic policies, which we've touched on broadly at Horizon here for a couple quarters now, continue to play out, and you're really getting into an environment where many different countries are taking very similar nationalistic views. So we'll continue to watch for the effects of those policies and what that does to the global economy, but also to markets as a whole. So with that being said, we've got a couple key takeaways up here on the screen in regards to what we just talked through. Obviously, volatility, fundamentals, and then geopolitics kind of being the high points that we hit on, specifically looking at the Fed's communication. At this point, happy to open it up for any questions. Again, folks can enter questions as part of the GoToWebinar software, or we will unmute lines here momentarily and give folks the ability to ask a question over the phone if that is easier. So if you give us just a minute, we will work on getting everybody unmuted, and then at that point, we will start to take any questions that folks may have. So at this point, we are unmuting line. Feel free to ask away. And you've got myself and Scott here, happy to address anything either we covered or anything that maybe we didn't cover. Maybe while we wait here on folks maybe thinking about questions or thinking about things that they're also, getting questions from clients on. Maybe just one question that we have gotten here more recently is, with the lag and the performance, I would say, of Scott, of international markets relative to the U.S. in kind of the recent time period, what's Horizon doing and kind of how are we positioning in regards to overweights and underweights in regards to international markets?
Yeah, it's a great question. So the upshot is we actually like international markets a lot right now, but only certain ones. So we really kind of like, we do like emergings. We hated it. So we came into the year like half and half, like 20-25% of emergings, a lot of developed international, and like 50% U.S. And we dropped that down pretty far in February, March time period. And we recently just like back in October we took up about 20% international, 20% emerging position again. We may be looking to increase that. There are certain things you look for when you're dealing with emerging markets. One of the big ones is currency stability. So the thing that got us out, one of the things that got us out of emergings back early in the first quarter was the fact that we were detecting some anomalies in the currency markets and some stresses in the currency markets in emerging market countries. And one thing that we know about EM investing is when the currencies start going haywire, you just get the hell out and you sit it out and you wait, because there's nothing that's going to matter when currencies matter. So currencies don't always matter, but in EM when they do, they're the only thing that matters. So you just can't even think about it until they start stabilizing again. That happened late this summer. And in the meantime, emergings got clobbered down 20 or 30% or whatever it was. And so the valuations became very attractive. The growth prospects are still pretty good over there. And oh, by the way, the Chinese put in a massive stimulus program starting in July, monetary, fiscal, and regulatory. So those stimulus programs take time to come into effect. They usually take between 4 and 7 months. We're sort of at the meat of when we would expect all of the stimulus that the Chinese put in over the summer to be taking effect now. And so that we do think the emerging side is pretty attractive. Europe is a little bit of a different story. We don't hate it, but we like the U.S. more. Japan is a position that's more of a stability position. But emergings really do like a lot right now, and it has a lot to do with the stimulus the Chinese put in and the currency stability that we've got. And actually, it looks like the dollar should head lower from here, based on market's new pricing of what the Fed is expected to do.
Yeah, and Scott, I was going to touch on that as well. Given kind of the recent dovishness of the Fed, it looks like the dollar may come under some pressure heading into 19.
Yeah, I mean, it really didn't react to a lot of the stresses and to the market totally repricing where the Fed was going to be. Again, that's a disconnect that typically resolves itself. It doesn't always happen immediately. But we expect over the next 3 or 4 weeks for the dollar to come into some at least some medium pressure to the downside as the new rate regime takes some hold.
Awesome. Well, it looks like I think that may be it in the way of questions. Doesn't look like anybody else has added anything in today. But again, happy to address any questions offline that anybody maybe thinks of post-call. And one thing to note is that this deck will be made available after the call, as well as the recording. We're obviously going to work on getting that through compliance so that we can get that out for everybody. And then one other thing to note is that there will also be a survey coming through. Given the fact that this is kind of the first quarter that we're doing this kind of group call, want to make sure everybody kind of likes the new setup and is comfortable with kind of the way that we've got it structured. So you'll see a survey coming over. We'd love your feedback in regards to ways that we can continue to fine tune and improve our processes here, so that they're most helpful for everybody on the phone. So with that being said, we will wrap up and look forward to talking to everybody soon over the next couple weeks. Thanks so much.